Hi Team Value, JJ here, welcome back. Well, today I'm going to react to this video with Joseph Carlson, who's talking about Wall Street permabull Tom Lee and his bull thesis for the market. Joseph agrees with Tom, and I want to react to both of them. I have reacted to this video before of Tom Lee, so I'm going to add to it by adding Joseph Carlson into the mix. He's a big finance YouTuber. He's been on here for 5 or 6 years, got a big following. I'm sure you know who he is. So let's get into it. Let's see what Joseph is saying today about Tom Lee.
Bears and bulls. The most notable bull in the market is Tom Lee, and he's becoming increasingly popular. If I was to measure the rise of Tom Lee and the popularity of Tom Lee, it is directly linked with the success of his calls. He is becoming more popular for good reason. He's correct, and he's consistently correct about things that many other people are wrong on, specifically price targets for the S&P 500. I've noticed the rise of Tom Lee over the past few years as he has made non-consensus correct calls. Back in 2020,
well, okay, let me dig into that a little bit here. So Tom Lee has been correct during bull markets. He's a perma bull, as I've said before, so he's always bullish on whatever's going to happen. Now, during 2022, he wasn't correct because that was a bear market, and there have been very few bear markets, which I guess is part of Joseph's point throughout this, is that there's been a bull market, and so bulls have been correct for a long time, really since March 2009, when Joseph wasn't on YouTube. I don't know if he was investing back then, but that was a deep bear market, and if Tom Lee was bullish during that, he would have been wrong, and he was wrong in 2022. He did get a lot of criticism then, and they have him on CNBC because he's always can be relied on to give short-term predictions, short and medium-term predictions. Anyway, let's get more into it. Let's see what Tom Lee and Joseph are saying about what's going to happen in the market and the predictions for it.
2020, 2021, 2022, 2023, he has been calling for seemingly outlandish price targets of the S&P 500 surging upwards more and more, while other analysts in consensus were saying, no, the economy is going to go down. The stock market's going to enter into a recession. We're going to have stagflation. We're going to have all of these issues. Tom Lee has said, no, no, no. These are going to resolve. The market's going up. We have ample liquidity. The economy's strong. And he's been correct. He's hit price targets that people thought were nearly impossible, or at least silly. And since he's done it so well and so consistently, now more and more people are paying attention to him. Let's go ahead and take a look at his...
It's true. Tom Lee is becoming more popular. His clips are becoming more popular as the bull market continues. But really my issue here with Joseph and with Tom Lee is the whole prediction thing itself. So Joseph doesn't seem to have a problem with it because Tom Lee's been correct. And Joseph doesn't seem to have a problem with this, even though he does talk about super investors like Warren Buffett, Charlie Munger, those kind of investors all the time, and he does look up to them. He should know that Warren Buffett says it's crazy to try and predict the market. Howard Marks as well. I've made recent videos about Howard Marks taking the temperature of the market. Howard Marks says, but these investors say you shouldn't try and predict what's going to happen with the market. You should just, look at individual stocks, the fundamentals, and buy when they're trading below intrinsic value, for instance. And that usually does happen when the market goes down or an individual stock, a temporary problem with one stock. But making these short-term predictions, Joseph seems okay with it. He thinks it's possible. Warren Buffett says it's impossible. You can get surprised. It's just that the bull market has been pretty bullish for quite a long time, and it's been a period, quite an unusual period, where we haven't had a long bear market except for 2022, and some of these tech stocks did go down. I know Joseph has invested in these big US tech stocks which have been doing very well. Anyway, let's get into more of what they say.
Get his most recent interview here. This is from CNBC, and he goes over his case on the S&P 500 and why he believes it will rise yet again another 5% to round out this year.
Fundstrat Global Advisors, managing partner and a CNBC contributor, but close enough for government work. You're right again. And once again, your rationale was borne out. It was that inflation would continue to cool. It's July 1st. You have a new target for the end of the year,
And this is a video I have reacted to before. I'll leave a link to that in the description if you want to see what I think of the full reaction to Tom Lee here.
Okay. I've already sort of foreshadowed some of the things you were talking about. The S&P earnings might even be above what you thought.
Yes, I think that now that we're at the mid-year, 2025 earnings look a lot stronger than we thought at the start of the year. We thought maybe 260. It's probably closer to 275, maybe 280, even 285.
So he just raised what he thinks the S&P 500 is going to earn this year, from 250 to 270 or even up to 285. He thinks earnings per share of the S&P 500 is going up, and this is why he's raising his price target once again for the S&P 500.
And I think the multiple we thought originally could be 20 times that number for next year, but given the Fed has more reasons to be dovish, and I think maybe the employment picture is softening, PE multiples actually could be higher next year. So I'd say between now and year end, stocks should be higher. I mean, we've had a strong first half already, and second half won't be as strong as the first half, but we should build upon those gains. So
just right there, he's predicting. He says the second half won't be as strong as the first half. We just don't know that. It's unpredictable. If people could predict with this kind of accuracy, yes, he may be right, but the probability of being right all the time is not very good. So, a black swan event can come out of the blue. We had a pandemic. That's what happened. He just doesn't know. And, he's predicting with some certainty here, which, as Warren Buffett says, you really can't do.
Yeah, it looks pretty good.
You have numbers. I mean, so if the S&P is 285, you possibly, that's earnings,
correct,
285, up from 270. Because the economy doesn't cool, multiples don't expand. In fact, they might contract from 21 to 20. So if you multiply 20 times 285, you get to 5,800.
Yeah, so that sounds like it would be within as a reasonable base case, that stocks don't have to have a prodigious second half. They just have to follow what typically happens in the second half, especially in an election year.
So Tom Lee is doing simple analysis of combining the S&P 500 earnings projection that he has, which is 285, and he's multiplying that by the multiple, 20 times earnings. When those things combine, you get around 5,700, which is another 3 or 4% gain from today. So he doesn't believe the market's going to rocket up another 15 or 20%, but he believes we'll have moderate gains from here to the end of the year.
So 5,800.
Moderate gains, but after last year was a strong year. This year's another strong year. Actually, Tom Lee has got a prediction for 20% compounding for the rest of the decade. So he is, very bullish on this decade, pretty much like a roaring 2020s, like the 20th century was really. And again, Joseph Carlson seems to agree with him and think that it's possible to predict these things with consistency. That is the issue, consistency, to predict the stock market with consistency. If people could do that, there'll be a lot more very wealthy people.
800 for the year, what would that be the total return of it? It's 15 now, so
so it's it's a little bit more than 20%,
which would be after last year's
24.
That's a couple of years. No one.
There we go. 20% annual increase from now till 2030. He's predicting. I mean, that's, as I said, they like to have people on these programs that predict. And he had this certain amount of luck involved here, as Warren Buffett would say. He'd be looking. What would Warren Buffett be saying if he was watching this? That's what
One really expected, I don't think.
That's right. I mean, that's painful for people who've been sitting in cash for 2 years, earning 5% because they missed out on a 50% gain, and that's 10 years worth of sitting on cash. So I think the end of this year is a little bit of a day of reckoning for those who've said, oh, I'm happy with my $6 trillion in cash earning 5%, when in reality, unless the economy is rolling into recession, the expansion will continue for some time.
He's forecasting, and so far correctly, that we'll have 2 years back-to-back of 20% plus gains. Now, a lot of people think that that's super unusual or very unlikely, but as we've shown before on this channel, it is not unusual to have market gains back-to-back that exceed 10%. The stock market almost never has average returns, and that's counterintuitive. You've been told that the stock market should go up between 7 to 10% on average over a long period of time. While that data is true, it leaves out the fact that the average is based on negative years and positive years. More often than not, the stock market either has a negative year going down 5% or 10%, or it goes up 15 or 20%. It never really has those years of the nice 7 to 10%. That is the average, not what really happens year by year. And Tom Lee knows this. He knows that the stock market has many years throughout history that go up 20% consecutively. That's not something unusual. So
that is true. What he's saying there is true, but Tom Lee is predicting 20% each year for the rest of the decade. It's not so predictable as that. You can't count on that. And by the way, this is not investment advice from me, although Joseph seems to be does give investment advice on certain stocks from time to time. I'm not allowed to give investment advice. I'm not a financial advisor. This is not a financial advice. It's just for entertainment, and this is entertainment. I find what Tom Lee says entertaining, and Joseph Carlson, and it's just general education and entertainment purposes. You need to seek your own financial advisor and do your own work when it relates to stocks. And betting on the macro and like this, what's going to happen with the stock market. And if we just go back to 2020, we can see what can happen there. And it did actually rocket out of that. Turned out to be a pretty good year. But 2022, these bear markets can come, unexpectedly. Yes, stock market goes up and down. It can be consecutive years of 20% or more, and that seems, last year was a good year, and this year could be a good year. I'm not saying it won't be, but what I'm saying is to look to somebody who's been right. I think it's not a great thing to do this, just to go on to look at any kind of prediction of what the market is going to do, say for the next 6 months, which is what's happening here.
So even though his call at first seems a little outlandish and it seems unusual, it actually fits well within history. Now, he also talks about how this is a day of reckoning for the bears. Notice him say that towards the end here.
Is a little bit of a day of reckoning for those who've said, oh, I'm happy with my $6 trillion in cash earning 5%.
He's correct here again. This has been a day of reckoning for the bears, and specifically one notable bear. This interview came one day before JP Morgan decided to let...
He's going to talk about somebody who has lost their job because they've made bearish calls. But, Tom Lee was talking about cash there. It should be noted that Warren Buffett and Berkshire Hathaway are sitting on like nearly $200 billion worth of cash, and he's not worried. Warren Buffett is looking around at prices in the US stock market and saying, is there anything that I want to buy here? And it has to be said that their pool of possible investments is pretty small because they've got so much money. He's bought things in Japan. That market was cheaper. So Warren Buffett's looking around and saying, well, there's nothing. He's not predicting what's going to happen. He's just looking and saying, well, there's nothing. Things are a bit expensive now. He has been buying certain things like oil companies and traditional energy, which is contrary to these tech stocks. But somebody like that is sitting on a huge amount of cash and happy with that 5% or so for the moment until things look cheaper. And, we've got Tom Lee and Joseph Carlson here who really are predicting that it's going to be strong, predicting the stock market. Is it possible to do that with consistency? No.
Let go of their most notable bear, who is Marko Kolonovic. Marko Kolonovic is one of the biggest bears on Wall Street. In fact, I believe he is the biggest bear, second only to Jeremy Grantham. He has had incredibly bearish calls over the past couple of years, and he's stuck by them. He's doubled down on his bearish calls, and he's been incredibly, incredibly wrong over the past couple of years.
One thing I do agree with here is it's having bearish calls and saying the market's going to crash and so forth. Doing that is the same as predicting to the upside all the time. What Joseph is saying here is that if you predict to the upside, you're more likely to be right because the stock market goes up over time. But these are short-term calls here.
So we have bears having a day of reckoning and the bulls having their time in the limelight, getting more and more popular, more and more esteem. A lot of people are suggesting that this is now a tipping point. A point where when all the bulls are celebrating and bears are getting let go or fired or exploring new opportunities, that is a tipping point. That is a sign for rougher times ahead. Only a month ago, there were notable people on Bloomberg saying that we need these bearish takes even if they're wrong. In a recent note, Klonovic, who was incorrectly bullish in 2022 and bearish in 2023, effectively doubled down on his latest out of consensus call, highlighting January data for consumers and producer price increases to warn that the market narrative is taking a turn for something like the 1970s stagflation. He said that this could lead to a period of sustained underperformance for stocks, like the one.
Okay, I'm going to skip ahead here because I get it. This guy's being very bearish, lost his job because of it. And, there are certain investors who are pretty bearish, and it's, predicting that what's going to happen to the downside is pretty much the same as to the upside, just a different way. Let's see if we can skip ahead here and see what he's saying.
2023. Google. And I'm wrong is wrong.
Here we go.
This is why overall it's very difficult to listen to market strategists, to listen to overall macro calls, because so many of them can't think for themselves. They want to stay in the herd of safety and just make predictions that everyone else is making. So if their predictions are wrong, they aren't uniquely wrong. You see, in the business of Wall Street, in the business of investing, people are okay being wrong. They're just not okay being uniquely wrong. For example, if I invest...
So what he's saying here is what Tom Lee's doing here is going against the consensus. I'm not sure if that's true. I have a channel, Stocks Today with JJ, where I'm commenting on the daily events from CNBC and so forth, these new channels, because it's entertaining and fun for me to do. But I am critical of these things quite often because vast majority are pretty bullish on what's going to happen. This AI exuberance is going to go on. A lot of people think that this is going to go on for years yet. I wouldn't say the consensus is to the downside at all. I'd say the consensus with these programs is with, as the bull market continues, people get more and more optimistic, as is happening here. He said that Tom Lee is becoming more and more well-known, getting more esteem because he's been right as the bull market goes on. But you can't, that's one thing, but to predict the short term like he does is a different story.
Invest in Google, and I'm wrong investing in Google, and Google turns out to be a bad investment. That doesn't really make me look so bad. I'm not going to get uniquely blamed for investing in Google and being wrong. But if I invest in Texas Roadhouse and I'm wrong on Texas Roadhouse, I am uniquely wrong in Texas Roadhouse. There's a lot more reputation risk in taking non-consensus bets and investing in things that most other people are not invested in. Because again, if you're wrong, you look uniquely wrong, uniquely silly. And in the case of market strategists, it's the same thing. You can afford with your job to be wrong if everyone else is wrong. Your job is safe in that case. But what you can't afford is to be uniquely wrong like Marko Klonovic. He was uniquely wrong for the past couple of years, and now he's being dropped from JP Morgan. We've learned long ago as species, as humans, that staying with the pack means safety. It's safety in numbers, and it's the same thing here. The reason that all of these
Okay, so the safety in numbers right now is these big US megatech stocks, which Joseph Carlson is invested in. And, it looks like it's, that nothing can go wrong with them. But if we look back in history, as Joseph likes to do, we can see the Nifty 50, where it was a similar situation where, the multiples crept higher. It looked like nothing could go wrong. These were the biggest 50 companies. Nothing could go wrong. It was McDonald's and companies like that. Kodak at the time, actually, I think. But, we can be wrong about it. The consensus is that the S&P 500 is going up because of that top heavy Nvidia, of course, but he likes Amazon. He likes those big stocks, and Joseph is pretty confident about that now because he's been invested in those rather than small caps. Small caps not doing so well. Although small caps I'm invested in, some of them are doing pretty well, so that's good. But you see what I mean? Like, people are getting pretty confident. The consensus is that these companies, these stocks, the big tech stocks will continue to run. I'm not making one, a prediction one way or the other. As I'm saying, prediction is the thing that's difficult to do, impossible to do consistently.
Strategists have the same calls and the same takes all the time is because they want ultimately safety. They don't want a bad outcome for themselves. So you have the case of Marko diverging from the crowd, making his own calls and sticking by them. This time it didn't work out, and the argument is, even though it didn't work out for him this time, it's still good to have people in the arena that are making these unique, divergent calls, that are sticking with their own unique research. I do agree with the analysis that it's good to have people that give their own unique takes and they stand by them, that they don't always seek safety in the crowd. But I also think that reputation matters. that your record and your judgment matters. Marco has been incredibly wrong for 2 years. He has cost a lot of people a lot of money that have followed his fairish and doomerish takes.
Okay, so that's a bit of a contradiction there. He's saying that it's good to be contrarian sometimes. And if we look in history, say of a Warren Buffett, he has been contrarian at times, like during that roaring bull market of the dot-com bubble. People were saying that he was wrong, he was out of touch, he was too old. And this was nearly 25 years ago. It was 25 years ago, and so if he's old. And people are saying the similar things about him now, holding $200 billion in cash. So Joseph is saying here it's quite good to be contrarian. It's just a bit of a contradiction, because being contrarian right now would not be running with this kind of AI exuberance right now and these big mega tech stocks. It would be looking for undervalued stocks in different areas, and Joseph is not saying this. So what Joseph is really saying here is it's good to go with the crowd, and that's okay. Howard Marks has said in a recent video that I will link to, he's saying that the consensus of the stock market is quite often right all of the time, but so oftentimes you have to pick your times to be contrarian. And so generally, staying with the consensus is okay until it's not, and you can lose a lot of money when you're not. If you are like a perma bull, you can't be like that all the time, and it's good to be contrarian at times. Where Howard Marks has chosen those times and said things are getting too exuberant here. He's taken the temperature of the market and said, hold on a minute, at these times when it's been like an obvious bubble, or to the downside where it's time to invest when things are at their lowest.
So he should have some consequences for his incorrect calls. If he can continually just call everything incorrect all the time and still remain gainfully employed and getting lots of compensation for it, then what is the price to pay for actually being wrong? There should be some consequence. Now, overall, with this debate of whether or not this is a tipping point, I don't believe so. I don't believe that this is some type of signal of a top. History shows that bears are usually wrong and bulls are usually right. The stock market usually goes up. The US is full of incredibly talented, intelligent people from diverse backgrounds all over the world competing to create the most value possible. The stock market captures the best companies in this incredible economy. The most talent is captured at the very top. The companies that are the most successful, the biggest compounders, they rise to the top of these indexes. They're built in such an incredible way where they capture and weight the best, smartest, most fruitful companies in the world. So it makes sense that the market typically goes up over time. Bears will continually be wrong on average, and bulls will continually be correct. So if I'm having to pick a team between Tom Lee or Marco, I'm going to continue to pick Tom Lee. I'll continue to align with the people that are overall bullish, because as history has taught us, they're usually correct. Now we move on.
Okay. So I don't have any problem with that. He's saying over the long term, the stock market goes up basically, but I do have this problem with these short-term predictions for the end of the year. It's going to keep going up. I mean, that may well be the case. It probably will be, in probabilities, investing's about probabilities, but we just don't know. And so why listen to anybody who's trying to predict this at all, and say, we look at individual stocks and we decide whether they're around intrinsic value above or below. It's, looking at the macro, very, very few people, just a handful of people in the world are able to predict the macro or invest based on that. Someone like Stan Druckenmiller, who's outperformed the market for decades. But in general, people like Tom Lee, they have him on these programs because it's entertaining, and, if he's, and in a bull market, he says he's going to be right, but he's basically trying to predict the market, what the market's going to do from week to week, month to month. It's impossible to do. Anyway, that's enough. This was a long one. If you did get some value out of this, do smash that like button to help the algorithm to spread it to more people, and do also have a look at Patreon if you want to. I'm just putting weekly investing updates on there. It's just $5 a month at the moment. I think it's pretty good value, especially as I've started the stock analysis secret sauce. These videos, these shorts, sort of snackable videos, I've got 3. I'm going to put 1 a week up there. Dive in and have a look. And it's also free to join over there if you want to, as a free member, and you can dive into more if you want to. So do go and check that out. I'll put a link in the description, and on screen right now I'm going to put a link to a video that YouTube wants watch next if you're watching on YouTube. And thanks to everybody for watching or listening wherever you're doing that. And I'll see you in the next one.